From Embark's headquarters in Dallas, Texas, you're listening to Accounting Matters. I'm Adam Olson, Embark's accounting advisory practice leader, and I'm joined again in the podcast studio with Sarah Kiefer, a managing director out of our Houston office, to talk about one of the most, I would say, popular, always trending topics, specifically with SEC registrants, and that's around non-GAAP disclosures. So non-GAAP disclosures obviously make their ways into a lot of different filings and earnings releases. We hear about them more and more, particularly from the SEC staff, as it's a popular area where lots of SEC comments are often raised. And we're seeing the popularity rise as registrants continue to add numerous non-GAAP disclosures to their filings to enhance the storytelling of their companies themselves. And so I'm happy to have you, Sarah, join me. I know you've spent a lot of time dealing with non-GAAP disclosures in your past and working with clients here at Embark. So glad to have you here. Welcome back.
Yeah, thanks for having me. I'm excited to chat about this.
So as I kind of alluded to kind of in the opening here, we do hear more and more. I know there's always people talking about SEC comment letter trends, and I think non-GAAP is always like one of the top items that's always picked on there. So it's definitely not something that's new per se, but maybe if you could just kind of set the stage for our listeners here as kind of where did kind of the concept of non-GAAP disclosures originate? And, what are we kind of seeing? Why are we seeing so much around this still today?
Yeah, so these non-GAAP measures are definitely not new. The SEC's had rules and interpretive guidance around this dating all the way back to 2001. In 2003, they actually adopted the rules, Regulation G and Item 10E of Regulation SK, to address the public company's use of non-GAAP measures, which are not calculated and presented in accordance with U.S. GAAP, of course. So, of course, these measures have increased in prominence over the last couple of decades, and the differences between the non-GAAP measures and the actual U.S. GAAP accepted measures have become notably larger over time.
Yep.
So, accordingly, the SEC has had an increased focus on these and issued some. They've actually issued multiple compliance and disclosure interpretations over the years to address these concerns about the non-GAAP measures. And the most recent of which was actually in December of 2022, which was pretty extensive.
Yeah. And I know we'll get into more of that in our conversation today, kind of talking about some of the themes they hit on there. But maybe if we're taking it back to the basics, for someone that maybe hasn't dealt with non-GAAP before, maybe they're a private company looking to become a public registrant and will now kind of use non-GAAP measures. What exactly does the rule kind of define qualifies as a non-GAAP measure? How do we think about that in terms of what the regulations say?
Yeah, so in accordance with both of those regulations we were just mentioning, they define a non-GAAP measure pretty similarly, and it's a numerical measure of a registrant's historical or future financial performance, position, or cash flow. And then it is adjusted to either exclude amounts or is subject to adjustments that have the effect of excluding those amounts that are actually included, so within the actual GAAP measure, or vice versa. Yep. You're including adjustments that are typically excluded in the GAAP measure.
Yeah, makes sense. Definitely helpful explaining that. Can you talk a bit about then what are some of the key requirements of the rules themselves around these measures? If you're a preparer and you're, working through your company's non-GAAP measures, what are some things that you have to keep in mind as you're thinking about some of those disclosures?
So in Regulation G, we also call it Reg G, provides the broad disclosure requirements that apply to all the public disclosures of non-GAAP financial data that a registrant might make. So this regulation, it's important to note that this applies not only to written disclosure, but any type of oral disclosure too. So that can include things like webcast or earnings calls or anything that a company might put out to the public.
Yep. Okay.
So Rule 100A requires those registrants to disclose a non-GAAP financial measure, but you also must present the most comparable GAAP measure with it. And then you need to reconcile from that GAAP measure back down to your non-GAAP measure. This needs to be quantitative, and it needs to be in really clearly presented manner so people can understand how are you getting from your GAAP measure to that non-GAAP measure. Then Rule 100B also has some high-level guidance on things that are prohibited or could potentially be misleading for these non-GAAP financial measures. This rule states that the registrant cannot publicly disclose a non-GAAP financial measure that contains an untrue statement or omits like material facts that would essentially make it misleading.
Yeah, so a lot of red tape involved here, which makes sense because obviously the SEC is there to protect investors and don't want to mislead investors with some of the non-GAAP measures that are used. So you mentioned things that are kind of prohibited within Rule 100B. Can you kind of expand on any other specific restrictions that the rules lay out? For example, trying to include or exclude certain elements of non-GAAP measures. Are there specific examples within the guidance that they tend to point out there?
Yeah, they specifically talk about like on a non-GAAP measure, you can't adjust it to basically eliminate or like smooth your results. So you don't, anything that's in like identified as non-recurring, it's infrequent, it's unusual. If it happened in the last couple of years or it happens again in the next couple of years, they're not considering it.
Can't characterize it as such.
Right. So that's going to be still considered a recurring item.
Yep.
Also, you can't present on the face of the financial statements any non-GAAP measures unless it is permitted by that particular regulator. Also, like when you think about pro forma statements, you don't want to present any non-GAAP financial information in those pro forma statements either. They cannot be on the face of those financials.
Yeah. And I know there's a number of others, and item 10E kind of goes through some additional items that are explicitly prohibited as it relates to non-GAAP. So definitely worth taking a read through for our listeners that may not be as familiar with some of the guidance there. So outside, I think a lot of people think about non-GAAP measures included in a company's recurring filings. So their annual 10K and their 10Qs, they may refer to certain non-GAAP measures. Where else do we typically see companies use non-GAAP measures? I know you hinted at it briefly, but maybe people didn't pick up on it, that some of these rules actually do apply to also like oral communication. So can you expand on some other areas where companies typically use non-GAAP in practice?
Yeah, definitely. Probably where we see this a lot is going to be like in your earnings release. So that's either furnished or filed in your 8K. And along with that, investor presentations. So if those investor presentations are filed, webcasts. So webcasts are a big one. They come out and they do their earnings release. That webcast portion of it as well is covered. And then sometimes on company websites, you'll see non-GAAP measures on like their investor page, or you'll just see it kind of highlighted in like graphics throughout, like whatever they want to typically highlight on their company page or on their about page or something like that. But the SEC non-GAAP presentation disclosure requirements they can be more or less restrictive just depending on where you're actually presenting and communicating this information.
Right. But just important to know that the SEC is looking at all these things, right? So
they
could raise into question if you're, may not just be in your typical filings that you may be thinking of, but they're also looking at other avenues that you could be presenting non-GAAP information that potentially could mislead or cause investor confusion. So if we're thinking about non-GAAP measures within filings themselves, so kind of circling back to that, like where specifically in those filings do we tend to see companies kind of place these non-GAAP measures? Are there certain sections that they tend to pop up more than others? Like what are some of the more common scenarios that we see with filings?
Yeah. So in your 10K, you're typically going to see this in like the business section, your selected financial data, your MD&A. In your Q, you're really just seeing it in your MD&A typically. And then for foreign private issuers, they'll see this in Form 20F in the operating and financial review section.
Okay. So if a registrant moves forward and they're going to include certain non-GAAP measures, let's say in their filings, I know there are additional disclosure requirements that have to kind of accompany those measures themselves. Can you talk a bit about what are some of those additional disclosures that need to actually accompany the measurement itself?
Yeah, correct. I mean, there are additional disclosure requirements like you just mentioned. Probably most notably is going to be the direct comparable financial measure that's actually calculated in accordance with GAAP. So For example, like if you're presenting adjusted EBITDA, like net income is the most closely comparable GAAP financial measure. So you need to present that as well. Then you're going to want to reconcile. So I talked about this a little bit earlier, but you're going to want to reconcile from that GAAP number back down to your non-GAAP measure. And it needs to be in a clearly understood format. A lot of times this is tabular. So a lot of times you're just doing a calculation step by step. Another thing is that registrants are going to have to disclose a statement for the reason that management believes that this measure is useful in evaluating their business, as well as like any other use of this measure. So if they're using it for any other reason, comp, anything like that, they need to disclose that as well.
Okay. Yeah, that's helpful. And I'll add, because we keep kind of harping on it, is that a lot of those disclosure requirements also apply. They're not just within the filings themselves. You also have to include some of these disclosures within earnings releases, investor presentations as well, so that you kind of have that full transparency around the use of those non-GAAP measures. So we did kick off, and we've talked about it throughout the conversation so far, that non-GAAP measures are very popular. I think the last I read, and you saw something similar, was like over 95% of registrants use at least one non-GAAP measure. I know a lot of people are using multiple non-GAAP measures in their filings and other places. So clearly they're very popular. Can you maybe just explain high level, like, why do companies feel the need to include non-GAAP measures? Like, what's the genesis for all this rules and regulation around this? Why are they so popular?
Yeah, I mean, if you think about it back to basics, like all registrants have to calculate and present their financials in accordance with US GAAP. And the reason for that is for comparability and uniformity across all of the issuers. But management a lot of times feels that the way that they're presenting non-GAAP measures actually gives investors a real insight into what their numbers and their measures are that management actually is using to manage the business, which typically, like we said before in those disclosure requirements, they're required to say how they're using this measure and why it's important. So a lot of times, if you're wondering why they're using it, they've got to disclose that anyway. So that's in there. They may even assert that these measures, provide a clearer picture of what the business is, how they're performing, what their position actually is. So a big thing is, like, because these measures are like deviating from GAAP, there's really no uniformity in this calculation. So you just see these, like, it just varies widely. It's kind of all over the place between the registrants.
All the adjustments, including, excluding certain things.
Right. And everyone does it differently. So they just have different reasons behind their methodologies.
Sure.
But this can create confusion and unintentionally mislead investors. So beyond those, like, obvious adjustments where we're trying to provide a more meaningful insight into what a company's performance is, there are other things where there's like industry specific metrics sometimes. So there'll be specific industries, like I know for sure, like insurance industry and stuff, they have certain adjustments that just provide more meaningful insight into that type of industry.
Right. So
sometimes you see that. You also see like forecasts and projections. So management sometimes wants to present a forecast. And obviously this is not like set in stone. This is expected, right? So, these are non-GAAP measures as well. But a lot of times they want to provide that forward-looking insight into their company, kind of where they think they're headed. You'll also see this with mergers and acquisitions. So this is really common. We see this pretty often where they want to take a look at what do the companies look like once they're combined. So you've got these combined companies. There's definitely synergies there. There's probably costs that are cut there, or maybe you are all moving into the same building, and like, you've got less lease expenses or whatever that happens to look like. So what are these synergies and potential performances look like between the two companies? So a lot of times just aligning between what that would look like in the future, but those are non-GAAP measures. And then sometimes we've got management that has compensation arrangements or agreements that are based on certain non-GAAP measures.
Yeah, definitely helpful there to kind of understand all the different places where non-GAAP measures might be used and the value they add for different registrants, definitely facts and circumstances based. Can you just, if we're thinking about just non-GAAP measures in general, like what are some of the more common, you've mentioned EBITDA and adjusted EBITDA, things like that, I would imagine are probably the most popular, but what are some of the other measures that we tend to see companies use frequently?
Yeah. So like you mentioned, EBITDA is super common. You'll probably see this in most companies' financials. that's obviously just your net income. You're backing out your interest, taxes, depreciation, amortization. But sometimes you'll see the adjusted EBITDA as well. It's where they then take it even a step further and they're adjusting it for other items. So then you'll also see something really similar to that called your adjusted earnings. So you'll see adjusted earnings pretty often. They're basically taking net income and then adding or subtracting things that are not typically in that GAAP calculation of net income. So you'll see that pretty often. Sometimes these are like non-recurring or unusual adjustments that they'll back out of earnings. Another one that's become pretty popular that we've seen a lot is your free cash flow. Okay. So free cash flow is really saying like how much money do we have left over from operations that we can use to either like pay dividends or like pay down debt or like what do we want to use this money for, but how much can we spend? So you're taking your operating activities, so your cash flow from operating activities, and then just backing out your CapEx, and that's getting you your free cash flow. Net debt, you'll see pretty often as well. It's a pretty straightforward calculation. It's essentially like, it's a liquidity metric and it's saying like, can we pay all of our debts if they become due right now? So you're taking all of your debt less your cash, that's your net debt. So definitely a useful measure. I think it's a pretty straightforward measure. It's really easy for investors to take a look at that and be like, can we get out of this if we need to?
Yeah, no, those are helpful and definitely ones that, for sure I've seen over and over used as well. Are there any measures then that the rules call out as being kind of exclusively non-GAAP? In other words, they're included in different filings or, earnings releases, investor presentations, whatever, but they wouldn't be subject to all these, non-GAAP rules, requirements, disclosure, things that we've talked about today. Earnings per share is one that I think of that comes to mind is, that's a GAAP measure. So the rule might explicitly state if you're using earnings per share, you don't have to worry about some of this other stuff.
Yeah, definitely. There's some like when you have operating and statistical measures, you'll see things like unit sales, maybe like your number of subscribers. There's also things like same store sales. So the revenue is presented in accordance with GAAP, but it's basically you're measuring just for a particular store. Right. You could have other financial measures that are required for certain regulators. You'll see this in the banking industry a lot of the time, but you'll have capital ratios that are required to be reported to those bank regulators.
Okay, that's helpful. So we've talked a bit over and over today that the SEC focuses on non-GAAP. It's a popular area where they issue a lot of comment letters to registrants. So clearly there are challenges in applying the guidance here. I know sometimes these measures can be intentionally or unintentionally be categorized as misleading by the SEC. There's a lot of times, this term of undue prominence where you're kind of trying to elevate maybe a non-GAAP measure over the traditional GAAP measures that raises scrutiny from the SEC. So what has the SEC done to help kind of address concerns that investors might have in maybe painting a rosier picture than what true GAAP financials might suggest?
Yeah. So, kind of as we were talking about earlier, like over the last 20 years, basically, the SEC has just released continual guidance on this. Their most recent, CD&I was released in December of 2022, and it really touches on a lot of what you were just talking about, those misleading adjustments, potentially undue prominence. But misleading really can be interpreted in pretty wide variety of ways. Right. So that guidance provides a little further clarification and even a lot of examples of what the SEC considers misleading.
Yeah, which I think's definitely been helpful. I've obviously read through a number of those. They do it in a very Q&A type style there, I feel like, which is easy to kind of digest. But maybe we can dive a bit into some of those more recent interpretations that they just put out. So what are some of the key themes around kind of misleading adjustments and things like that were included in this most recent release?
Yeah, two probably of the biggest is going to be like your misleading adjustments and your clear labeling. Misleading adjustments, it may not be explicitly prohibited, but it could still be considered misleading. So it, again, very vague, right? But trying to provide some examples there of what that entails. So there could be like discrepancies against what's considered a normal operating expense that occurs regularly versus what's truly a non-recurring expense. So we touched on that a little bit earlier too.
So just how you categorize things and
right.
your judgment of what you think gets challenged by the SEC as far as whether this is recurring or not.
Yeah, definitely. So like one particular example is if something is not presented consistently between the periods, the presentation of that measure is pretty significant. And like, say you adjusted for it in a different way in the prior period, and now you're adjusting it in a different way, you need to go back and recast that prior period. So if this is a significant change between what you have presented historically, you need to go back and kind of recast so that everything is really consistently presented.
Okay.
So if something changes in management's eyes, like we want to change the way that we're adjusting this because of new information, because of XYZ, then they need to go back and recast prior periods too. But also like you can't just pick and choose kind of what you want to adjust. Like you can't just adjust for charges and expenses, and not adjust for gains, because this can also be misleading for obvious reasons. But, basically can't pick and choose what you're adjusting for. You need to have like an actual reasoning behind it. And it needs to be consistent. Another point in the guidance is basically, if you change your pattern of recognition, so like, or your basis of accounting, like an example, if you went from accrual to cash basis or something like that, that would be considered individually tailored and could be misleading.
Right. Okay.
Yeah. So then like with clear labeling, it's really just making sure that these non-GAAP measures are appropriately labeled, clearly defined. You may be in violation of Rule 100B if you fail to identify and describe these non-GAAP measures, or if you present it with a label that doesn't actually reflect the nature of the measure itself.
Yeah, and I know we touched on the undue prominence. Can you just maybe expand on kind of what they hit on as it relates to undue prominence of non-GAAP measures?
Yeah, so in accordance with item 10E of Reg SK, registrants can't place any more importance on the non-GAAP measures in comparison with the GAAP measures. So this is kind of what we talked about before, but basically there's a few different ways that you may potentially place prominence on those non-GAAP measures, whether it's intentional or not. One would be if you started your reconciliation with the non-GAAP measure and reconciled back to your GAAP measure. Can't do that. They explicitly state it's got to go from GAAP to non-GAAP.
Yep.
You cannot present a non-GAAP like income statement or reconcile back to this without the most directly comparable GAAP measure. If you presented the non-GAAP measure before the GAAP measure, or you intentionally omitted the GAAP measure, that would be a red flag. If you do any like ratio calculations with the non-GAAP measure, you also have to do it with the GAAP measure. So you've got to do both. And then similarly to that, if you're going to present like a graph or chart, like for example, like say you're going to have a chart that shows adjusted EBITDA over the last 5 years or something like that, you're going to want to have a similar chart for net income.
Yeah.
Yep.
So you touched on it a few times as you're kind of walking through that, your last kind of response there around kind of the most directly comparable US GAAP measure. So if a registrant is trying to figure out for their non-GAAP measure, what is the most directly comparable GAAP measure? Are there specific things they should keep in mind? Is there kind of common practice? Like, how does the SEC view what is considered the most directly comparable GAAP measure?
Yeah, I mean, thing to keep top of mind is if you're presenting a non-GAAP measure and it's used for performance assessment, you're going to want to compare that back to some financial statement line item in your income statement. Similarly, if you're looking at a liquidity measure, you're going to want to compare that back to something in your cash flow statement. So that's kind of high level, like the main things you want to focus on. There are some specific call outs, like we mentioned before. If you're presenting EBITDA, like you need to reconcile back to net income, like that's specifically called out in the CD&I. There's potentially also, if you are doing something like a per share amount, you're going to want to reconcile that back to your earnings per share that's in your income statement. So there are some specific examples within the guidance, but main thing to keep in mind is if it's performance related, you want to reconcile back to the income statement. If it's liquidity, you're typically reconciling back to your cash flow.
Yeah. And in some cases, probably some judgment that needs to be used if maybe you've got a measure that's both performance and liquidity based, right? Maybe you need to reconcile back to kind of both types of measures. All right, that's helpful. And I know also in the guidance, I've seen this come up a few times, is that the SEC staff's kind of indicated that if the reconciliation of the non-GAAP financial measure to the most directly comparable measure is a pro forma measurement that's prepared, but it's in accordance with Article 11. The SEC did actually kind of address this specific fact pattern and said that measurement can be used for reconciliation purposes in lieu of an actual GAAP financial measure. So kind of a little nuance there for folks that may also be thinking about pro forma measures and how that might relate to this reconciliation process. So let's just quickly switch gears here. Maybe think more about kind of operational side of things. So since non-GAAP measures are presented outside the financial statements, we've talked about these are Reg SK rules and things of that nature, or they're not even in filings themselves. They're not technically subject to a company's internal controls over financial reporting. Obviously, we've talked about how important they are. We've talked about how many registrants are using them. Yeah. We've talked about the SEC really leaning in hard on these and watching the use of non-GAAP measures very closely. So, clearly they have to be reliable. They have to be transparent, things of that nature. Can you talk to me then about how does management ensure that the measures and disclosures they are using in the non-GAAP space, actually are reliable, aren't misleading? Like what do they have to be thinking about? What do they put in place to kind of cover their bases there?
Yeah. So kind of like, as you just mentioned, only really the GAAP information is going to fall under your internal controller of financial reporting. So what's in your actual financial statements. But in the case of like non-GAAP measures, the preparation of these measures fall under the public company's disclosure controls and procedures.
I know the difference, but I don't think everyone here probably knows the difference between internal controls over financial reporting and disclosures, controls, and procedures. Like, what are the nuances between, how do we distinguish those two?
Yeah, so when you think about disclosure, controls, and procedures, these are broadly defined by the SEC as controls and procedures that are designed to ensure all your required disclosures and information are recorded, processed, summarized, reported, in all time periods specified by the SEC rules. So management has to evaluate your disclosure controls and procedures on a quarterly basis and disclose in the Form 10-K or the Form 10-Q whether that evaluation was effective. Okay. But on the other hand, like if you're thinking about your internal controls over financial reporting, it's limited to providing reasonable assurance about just reliability of your financial statements and the preparation of those financial statements in accordance with GAAP. The objective of internal controls over financial reporting is limited there. So it doesn't extend to other forms of financial reporting. So sometimes too, like management may want to extend the application of their internal controls over financial reporting even to those non-GAAP measures, just because they're so prominent a lot of times. They're in a lot of earnings releases, like we said, they're in webcasts, all this stuff. They're out there. So sometimes they want to extend their ICFR over that as well. Even if they do that, their auditors technically are still not reviewing that piece of it. So it may just be covered by management's review of those controls, but technically not covered by the auditor's review.
Right, because they're just worried about stuff right in the financial statements and the related footnotes to those financial statements as far as like their report on ICFR.
Yeah.
Helpful there for sure. And so maybe just before we close, I know we've covered a lot today. So appreciate all your insights so far, but just if I'm thinking about like everything we've covered since we've started this conversation, and trying to come up with like key takeaways for our listeners here at the end, like what are some things that you would want to point out to management teams that they kind of need to keep top of mind as it relates to just non-GAAP measures and disclosures?
Yeah. So probably top of mind is that you've got clarity and transparency over these numbers. You're providing investors with meaningful understanding of the company's financial performance, but you want to avoid using like overly complex or confusing metrics that may mislead your shareholders. You also want to be consistent. So we talked about like you can't constantly change every single period, what you're including, excluding, what that looks like. So you want to have just consistent measures so that as time goes on, investors can really take a look at how if the management is asserting that this is an important measure, what does that look like over time?
Right.
So. You also want to avoid the exclusion of important items, of course. You want to use comparable metrics. So make sure that you have the most directly comparable US GAAP metric. Make sure you have that clearly identified. For forward-looking information, you really want to avoid presenting non-GAAP metrics that solely focus on future projections, because these can be unreliable. We don't know the future always, and it can be misleading to investors. And then you definitely, any type of explanation that management is going to put about like why this is important needs to be a plain language explanation. We want to be sure that this explanation very clearly describes the purpose and the relevance of this non-GAAP metric, and ensures that investors like truly understand what the implications are of this metric.
Yeah. If management can't articulate it well, then I'm sure an investor's like,
Right.
what is happening here? That's probably a red flag for sure. Yeah. And then I would just probably add just a couple things. I mean, we just talked about controls. Obviously, I think even though ICFR doesn't have to apply to your non-GAAP measures, just kind of like the importance and the prominence of those and the use of them and how widely they're used today. I think it's just, strong internal controls and policies for how you calculate and present are important for management to keep in mind. And then just overall like governance, like any other aspect of the business here, just making sure that there's appropriate oversight for, what they're preparing, what they're measuring, what they're disclosing, that's being reviewed by either the audit committee, the board, somebody that has a little bit more authority from an oversight perspective, and making sure that the company is following their policies and procedures around non-GAAP. So, well, thank you, Sarah. I appreciate, I know we've covered a lot today. Like I said, a lot of great insight. I know you've, it's an area that you help a lot of clients navigate, and we help clients all the time navigate, especially even on the comment letter side that they may get from the SEC, how to respond on some of this stuff. But an important area, nevertheless, that companies need to be making sure that they're keeping up to speed on and paying close attention as the SEC continues to provide additional interpretations and guidance in the space, really to just enhance that registrants are doing the right thing. But for our listeners, definitely, if you'd like to continue the conversation, reach out to either Sarah or myself on LinkedIn. We'd love to connect with you guys. And until next time, thanks for following along on another episode of Accounting Matters.